Thank you, everybody. Can you hear me all right? It's awfully nice to be here, and I know it's a tough time slot to be between all of you and lunch, so I'll try to make this as efficient as possible, but hopefully informative as well. Every year, my friends and I at Asia Partners try to put our thoughts together on what's happening here in Southeast Asia. What are we observing? What are we seeing? What are we learning from all of you and from our portfolio companies? And we've been doing this for about 3 or 4 years now. What I'm going to share today is a little bit of a product of that process, and also a few things that if we did a report next year, we might have published. I'm thinking about taking a break next year for the report, so this may be one of the few times we share some of those exhibits that would have ordinarily gone into what we publish. My first topic of conversation is really why Southeast Asia. Is it indeed a bright spot in an otherwise very dangerous and very troubled world right now? One way to think about it is simply to look at it numerically. The IMF every year tries to analyze what the different growth rates might be for different parts of the world. And I'm here to tell you that over the last 5 years, you absolutely were correct in focusing on China. China was top nation in terms of its growth, followed by Vietnam, Malaysia, India, and others. What is remarkable is the realignment that is taking place in Asia today with Vietnam, Indonesia, Philippines, Malaysia, Thailand, Singapore, all exceeding what is expected to be the growth rate of economic output in the US. I think the great unspoken fact, though, is how attractive Southeast Asia is from a demographic perspective. We're sort of used to thinking about Asia as a young continent. That couldn't be further from the truth. In fact, some of the largest economies in Asia, whether they be Japan, China, Korea, are actually declining in terms of their total aggregate population. The simple way to think about this, back to Pareto principles and even power law distributions, is that the world basically has about 29 countries out of the 100 or 200 out there that represent half of the population. And of those 29, a very large number of them are arguably challenging from an investor perspective. And off those 29, 6 of them are shrinking, or at least flat in the case of Germany. We are so lucky in Southeast Asia to have 4 of the remaining 23 that are indeed growing. And what you see here, and these numbers don't seem like very large numbers, but they creep up on you as the decades go by. Southeast Asia has some of the very best growth rates of population, but total population alone doesn't tell the story. One of the things that we really like to zoom into is the working age young population. Pretty much everybody in this room, with a few exceptions. And if you think about that, China peaked in 1998, 25 years ago. Japan peaked, Korea peaked, also in the 1990s. India, which we've all thought of as this very young demographic dividend country, India peaks in 2026. In fact, Southeast Asia, of all the parts of Asia that are large, peaks last. And within Southeast Asia, we are so grateful to have countries like Indonesia that peak in the 2030s, and the Philippines that peak in the 2050s. There's a line in the Bible, the Christian Bible, Matthew 5:5, the meek shall inherit the earth. I think in a tongue-in-cheek sort of way, I think the Filipinos will inherit the earth because they will be the ones still around in the 2055 sort of era. Now, that's great from a high-level perspective, but I think a lot of the folks in this room are more focused about practical considerations. Can money be made as investors, as entrepreneurs in Southeast Asia? A fascinating fact is that in a year of turbulence, in 2022, a year when most of the world lost money in the equity markets, bar Turkey and a few others, 5 out of our 6 countries outperformed American equities by at least 8 percentage points. That's a very, very meaningful observation. And interestingly, if you look at now 2023 year to date, the full story has not been written, but if you just think about the first 9 or so months of the year, while it is definitely the case that America has come back roaring in terms of equity valuations, interestingly, most of the countries of our region have outperformed China from an equity value creation perspective as well. Now, I want to emphasize something that's going to be a more and more important topic of conversation. Many folks around the world at the LP side and the investor side have often ignored Southeast Asia, with much more capital going to China, India, Korea, Japan, even Australia. As they start to focus more on Southeast Asia, they're going to be asking entrepreneurs and other local investors more precise, more granular questions, one of which will be about FX. Because that tends to be, in my view, the classic throwaway comment. The classic, oh, I'm not sure I want to do this, so let me ask about this risk. Interestingly, Southeast Asia actually is quite favorable in this metric. I don't mean FX by itself. The important thing that we think is important to focus on is not the FX rate by itself, which for many emerging markets is always a downhill trend. It's the combination of local inflation and local FX. Why? Because if your business is pricing, as every business in this room does, in line with CPI, in line with inflation, and then you have the FX erosion, what you're really delivering to your shareholders in dollars is the net effect. And on the far right column, you'll see the net effect of this. It's actually been very benign relative to, say, the US economy. And more recently, if you think about just the last 5 years, Southeast Asia's long-term FX erosion certainly, hasn't been positive, with the one exception of the Singapore dollar, which is loosely pegged to the US dollar. But these numbers compare quite favorably to our neighbors in India and Japan. If anybody has been wondering why so many tourists have gone to Japan over the past 2 years, look no further. The whole place is on sale. So there's a lot to like about the macro backdrop over here. We made this chart for 2022 that looks at the stagflation dynamic, if in fact we're reliving the 1970s. And this chart in many ways looked like we were. Most of the world's countries that were investable had an inflation rate higher than their GDP growth rate. That means they're in the red penalty zone, whereas 3 out of 6 countries in Southeast Asia were in the safe zone. Interestingly, in 2024, 23, we've improved. 4 out of our 6 countries are in the safe zone, and with the exception of Singapore, the only other one that's in the red zone, Vietnam, is quite close to the border. So again, there's a lot to like about the fundamentals of Southeast Asia. But something that we want to share that we've never shared in a broad tech in Asia context before, and if we did a report next year, this probably would have been one of the core things we'd share, is something that we call the emerging market sweet spot. And a number of our colleagues are big fans of tennis, and of course in the game of tennis you have a racket, you hit the ball, and you can feel it when you hit the ball in the right spot of the racket. That's the sweet spot. And I want to really talk about this for a second because it has such a lot to do with how people think about emerging markets and when is the right time to focus on different parts of the emerging world. Every global investor that looks at investing in an emerging market, in one of your companies, in one of your businesses, is basically making one of 3 logical arguments to themselves to convince themselves. They're either saying the population is very large, they're saying the GDP is growing, or they're saying that the GDP per capita has reached an attractive level. It's that third argument, the GDP per capita argument, that we feel doesn't get enough attention. It's the third and least focused on arguments that people make. Look at any of your pitch decks, look at any of your competitors' pitch decks. They talk about GDP, they talk about population, but do they talk enough about GDP per capita? We think this is very important because consumer internet and tech more broadly really comes alive when simultaneously you hit $1 trillion of GDP and you hit 4,000 of GDP per person. Now that GDP per person and the trillion are moving targets because of inflation. This is in 2023 dollars. What do we mean by this? Well, imagine a simple chart, and some of you who have heard Asia Partners talk before have heard us say that anything worth plotting is worth plotting on a logarithmic axis because that normalizes for exponential growth. On the horizontal axis here, you'll see GDP per person, and it's a doubling axis. 0.25, 0.5, 1,000, 2,000, 4,000, you know where this is going. And on the vertical axis, it's the total GDP for the country, $1 trillion, $2 trillion, $4 trillion. The simple hypothesis that we have is that you have to be in the yellow zone. That's when consumer internet explodes and creates tremendous amounts of value for the individuals, the entrepreneurs, and the investors in this room. Now, there's a nuance. Do you see how there's a yellow zone and an orange zone? We're not saying that things get uninteresting in the orange zone. In fact, they get better. That's when an enormous amount of value gets created, but it tends to be created by the already public companies when you're in the orange zone. So for startup founders, for startup investors, the sweet spot is the yellow. You don't want to be too early and you don't want to be too late. Now in astronomy, there's a wonderful concept called transits. You can actually see a moon or a planet transiting across another body. And what I want to show you now over here is the transit of China. And what you see is 1980 to the present day, China enormously growing over this period of time on a double log axis. But the important point is in 1986, China crosses the first threshold. But there's no Nintendo from China. There's no Toshiba from China. There's no Meituan. There's no Tencent. There's no Sony. There's no EA. There's no nothing. It's in 2005 that China crosses both thresholds. China is now in the sweet spot zone. And around 2014 or 15, it starts to move into the zone where you're often better off in the public markets. And this is perfectly mirrored by what actually happened. Just to decode what I'm about to share with you, imagine tech as an octagon with 8 basic food groups: protein, carbohydrate, fat. Well, we've got 8 of them in tech on this simple framework. And if you look at the mix, the composition of China market cap in tech, adding up to 100% in dollars year by year by year, you notice how in 2005, consumer internet and e-commerce explodes. And that is precisely because it's in 2005 that China enters the sweet spot. It's almost like clockwork. And that explodes from 5%, peaks at 51% of total China market cap, because China is now in the sweet spot. Now look at India for a second. And we love India. My parents are from India. There's a lot to like about India, but India is not yet in the sweet spot. We have great respect for people that look at India as investors and entrepreneurs, but India is not going to hit what we think of as the sweet spot for consumer internet and e-commerce until 2033 or 2034, give or take. It's on its way. It just hasn't reached that train station yet. And yes, when you look at India's mix of market cap, the green is only 6%. Billions and billions of dollars have gone into consumer internet and e-commerce in India, and there have been some incredible successes like my business partner Oliver's investment in Flipkart. But in general, I would say this is a small number. This is a small number. The real money in India has been IT services, which is the much, much larger category, in part because at India's wage levels right now, it's not yet in the sweet spot. And what does that mean for us in Southeast Asia, if this is a pattern? Well, we are very happily the only part of Asia, in fact, the only part of the world, bar the Arab world and a certain cut of it, that's entering the sweet spot and solidly in it for quite a few years to come. This is unbelievably important because golden ages are more often recognized in retrospect, but this is the time to be here in Southeast Asia right now. In fact, if you look at every country in the world, the only country by itself that is in the sweet spot, the only one is Indonesia. Now, you don't get to pick this. This is just what the facts are in the world. There is no other country like Indonesia that's entering the sweet spot and will be here for a large period of time. And that is what you see in the data as well. When you look at the mix and the evolution of tech market cap, it took a few more years than when we originally hit the sweet spot because of the complexity of stitching the region together. But you can definitely see by 2015, 2016, things are beginning to pick up. We went public in 2017 at C, and this thing peaked at 37% and it may continue to grow over time. That's because we are the only part of the world right now, bar a few other areas, that's in the sweet spot right now. Now, it raises an interesting question. What do you do if you want to be addressing all of Southeast Asia? Again, Indonesia is by itself there. That's relatively straightforward. But many people in this room, and I will guarantee you many people in the limited partner community, the people that fund the VCs that you may be talking to, are skeptical that Southeast Asia is addressable. They look at this and say it's just arithmetic, but meaningless. And I can't tell you how many people have told that to us over time. What is interesting is that perspective has to confront the reality that entrepreneurs are doing it. The old joke is, it works in theory, but does it work in practice? People that reject that Southeast Asia is addressable are effectively saying it works in practice, but does it really work in theory? And if you look at Southeast Asia from a logical chessboard perspective, you tend to find 2 strategies that emerge. There's a strategy of just doing Indonesia, a la Gojek, Tokopedia, many others. And there's a strategy of doing the entire region, a la Shopback, Carsome, Red Doors, Sea, Grab, and others. hope springs eternal that there will one day be a single country Vietnam strategy or a single country Thailand strategy that gets to a large US public company size. Again, hope springs eternal. Perhaps one day that will happen. And the way that you actually implement this is now solved. And for everyone in the world that says, in a sort of snarky sort of way, oh, Southeast Asia, it's just a ragtag bunch of countries that aren't addressable, they have to confront the fact that Grab has done it. Sea has done it. ShopBack has done it. Carsome is doing it. Red Doors is doing it, and many, many others. And the way you do it is not by ignoring Indonesia. In fact, the really interesting thing is that the two largest Strategy 2 companies have half to two-thirds of their people in Indonesia. It just means that you're doing it on a regional basis while showing appropriate respect and attention to Indonesia. But what happens if you miss the sweet spot? Southeast Asia is in the sweet spot. Indonesia is the only country in the world in the sweet spot. By definition, that means that the other 5 countries of Southeast Asia are not in the sweet spot. Well, what happens? Well, interestingly, there's a path for a country that involves doing something a little different than building a domestic consumer internet platform a la Sea, a la Grab. And what we tend to find is a recurring pattern. If you live in the lower left of this chart, you often become a specialized export powerhouse. What do I mean by that? Look at Korea. LG, Samsung, Nexon, Lion, if you give it credit for being a Korean company in some ways. These are export-driven businesses. They go somewhere else to sell the technology. It's very interesting. And if you look at Korea, this is exactly what their market cap mix looks like. The green is relatively small, and in fact, a good chunk of that green is actually reselling games into China or reselling content or other technologies on a more global basis. Really, Coupang and a few others are the Shopee equivalents for Korea. It's mostly an export powerhouse. Look at Taiwan. Very similar dynamic. Subscale to generate a very large US public company for a domestic consumer internet, but it's got one hell of a semiconductor sector. There's no doubt about that. Export powerhouse. Look at what Vietnam is going to do. Vietnam is following a remarkably similar path to South Korea and a remarkably similar path to Taiwan. And one of the things that we find really interesting about Vietnam is that quietly it has become a force to be reckoned with in semiconductors. 41% compounded growth for 20 years is an extraordinary achievement. And not only that, we have a thesis that if a country is good at low-end discrete manufacturing, i.e. textiles, it should get itself into automobiles, and it should get itself into electronics and semiconductors. Vietnam checks all 3 boxes. Japan checks all 3 boxes. Korea, China checks all 3 boxes. The jury's out on Taiwan, which never had an auto industry, and the jury's out on India, which doesn't yet have a chip industry. But mark my words, Vietnam is absolutely going to do all 3. And it has the double benefit, again, on a log y-axis, of sending the most students to US universities for higher education. We're staggered by the fact that Vietnam has 40% of the population of Indonesia, but sends an order of magnitude more students to America to study engineering and business and accounting. This is an incredible advantage that will accrue to Vietnam's benefit over the next 20 years. And it's no surprise that some of the most entrepreneurial people in Asia on a per capita basis, the South Koreans, have focused on Vietnam. If you look at the graduates of the top universities in Korea and look at how many of them are working as CEOs or founders in tech in Southeast Asia, a huge number have picked Vietnam for very sensible reasons. Philippines, if you kind of eyeball it, it's probably going to do a drive-by off the sweet spot. You know, it might just manage to clip it for just a moment or two, but that suggests again that the Philippines' destiny is not going to be as a producer of large, independent, single-country consumer internet platforms. Its future is probably as a piece of Shopee, as a piece of Grab, as a piece of ShopBack. Malaysia, very similar to Vietnam in certain dimensions. Huge amounts of effort going into semiconductor foundries, hard drives, and the like. Thailand, again, has missed the opportunity to be in the sweet spot. You will see Thailand being an incredibly important pillar of regional platforms. A fun fact and an important fact, when we went public in 2017, the banks made us disclose our revenues by country. Thailand was our largest country by revenue across the entire business, including Indonesia and including Taiwan. Last but not least, Singapore. What's Singapore's role in all of this? It, in many ways, follows a similar pattern to South Korea or Israel or Taiwan, for that matter. Too small to generate a domestic market, but interesting in terms of what it could create on a regional basis. Clearly, Singapore is playing a hub role. People often ask, what's the capital of Europe? It's probably London. People ask, what's the capital of the Middle East? It's probably Dubai. And if you go through LinkedIn and data mine it, and you ask who are all the people globally whose job title includes Asia Pacific, APAC, or Asia, it is remarkable that 1/4 of them globally live and work in Singapore. So Singapore is clearly playing a pan-regional role. I looked at companies like Shopback, who are not just ASEAN, but now truly global in terms of having operations around the world now, including Europe. Singapore is the home base. And we can learn a lot about what's going to happen both in Southeast Asia and more broadly by what the ultimate smart people are doing, not the VCs, not the investors, the employees. The ultimate wisdom of crowds comes from the movement of very talented young people in terms of the companies they want to go work for. And what's so interesting is to see what's happening. There's been an enormous shift of talent, a drop in the bucket for China, but enormous by our standards in Southeast Asia, of great talents coming from China and setting up businesses and running businesses here in Southeast Asia. That at one point was increasing daily, or at least every 3 days, in terms of the trickling in of great entrepreneurs from north coming to the south. You're seeing a very similar dynamic of entrepreneurs from India, and we talked about Korea just a few pages back. But the really interesting story, in addition to importing great talent, is what I would call the recycling of talent. One of my favorite charts in all of tech is this chart. It's the family tree of the silicon in Silicon Valley. This is the family tree of how the semiconductor industry was born. And Intel, one of the best companies of all, doesn't even show up until 1968, about a third of the way across from left to right. It all begins with Bell Labs and Shockley and Fairchild Semiconductor. In a similar sort of way, these 8 companies, with all due respect to the even earlier ones like JobStreet and Deal Guru and others, these 8 companies have become the equivalent of Fairchild Semiconductor or Intel here in Southeast Asia. In retrospect, and it was hard to see at the time, I certainly didn't see it. I just invested in one of these 8 companies. I should have invested in all 8. But in retrospect, this was an incredibly powerful and fertile time for Southeast Asia. These 8, who naturally cluster into 4 that were regional and 4 that were just focused in Indonesia, have become the grandparents and parents of a whole new generation. Look at the Zalora Mafia. What an incredibly talented bunch of people. Henry and Joel, Dion, Chris, and others as well. But it's not just Zalora. If you draw a map of talent in Southeast Asia, and this isn't just us guessing, this is based quantitatively on the net flows of talent from company A to company B across the 38 major participants in the talent ecosystem, it sort of looks like this. And one of the most interesting conclusions that comes out of this chart is that you can actually start to see the composition of companies almost like the nutrition facts label on the back of a tin of food. Let me give you an example. Now, ByteDance has been in the news for all sorts of reasons over the past 2 weeks with the ban here in Indonesia. But one of the most interesting things to see for ByteDance, not just Indonesia, but the region as a whole, is how many people they have taken from Sea, from Grab, from Lazada, Zalora, and to a lesser extent from the other 4 of the big 8. 22% of their headcount in Southeast Asia are alumni of the big 8. It should have come as no surprise to anyone looking at this data back in December 2022 that they had e-commerce ambitions. A lot of these people are ex-Shopee people that are powering their e-commerce division. Carson's is another great example. They've hired a lot of people out of Grab and Lazada. So is Shopback. In fact, a huge percent of Shopback, forgive me, the 22% is for Shopback. The numbers for ByteDance are closer to 18%, but 22% of all of Shopback comes from the big 8, notably Sea, Grab, Lazada, and Zalora. There's something to be said for this. We think it's incredibly important to follow where the alumni of those first 8 companies are going and where they're going next, because they're leaving behind unvested stock to make a career decision. That's something worth focusing on. Final topics, what's going to happen to IPOs in Southeast Asia? No one in this room will be surprised to hear that there's been a dry patch for almost 18 months now. In fact, arguably now closer to 21 months. It's a topic that's close to my heart. And one of the happiest moments of my life was having a chance to go back to my hometown of New York City and go whack that good old bell. And I think the most important point is that we've made money for our shareholders. We listed at 15, we trade at 46 today. We've basically tripled capital on a per share basis, which is all that matters from a customer service perspective to your investors. Let me start with the obvious facts. 2021 has left a very sour taste in public market investors' mouths. That is a huge reason for why there have been no real IPOs in 2022 and only a few in 2023. If you look at the data, there were 115 IPOs of a certain size or greater in tech globally, and 70% of them have lost money. That doesn't leave a good taste in the mouth. And those 5 that more than doubled aren't enough to offset the 79 that lost money. But what's interesting to talk about, and this is where the study of history can be really helpful. We know so little, so we want to understand things at Asia Partners. We look at history as a guide. There is a 3 or 4 year cycle that goes back to the days of Netscape and their IPO, where IPOs get overvalued, that means being below the line, or IPOs get undervalued, that means being above the line. And the undervalued IPOs leave a nice happy smile on the mutual funds' faces, and 2 years later they overpay for IPOs, which leaves them with a big old frown, and 2 years later they underpay for IPOs, and the cycle continues over and over and over again. 2021, clearly an overpay moment, but the IPOs of these next few years are going to be fairly valued or even a bit underpriced, which bodes very well for the IPO market staying open. We made a prediction back in 2019, and we hold ourselves to this every single year, that there would be 10 more billion-dollar public companies in tech from Southeast Asia over the next 10 years. In retrospect, it was a pretty humble suggestion, but at the time, people thought we were crazy, because from 2004 to 2019, there had been only basically 0.5 per year. We had the audacity to say there'd be 1 per year, and we were wrong. There's actually been 2 per year. It's been even better than we had expected. Part of that was no doubt the bubble of 21, but nonetheless, we're on track, and we're on track because of a very simple principle that holds across every industry: mean reversion over time. On the left-hand side, you'll see the global mix of tech market cap. This is our industry in simple numbers. It's 10% telco, it's 19% hardware, it's only actually 21% internet, despite all the emphasis it gets at conferences like this, and it's 19% software in terms of market cap. Southeast Asia looks like China did 10 years ago. And we will look more and more like China over the next 10 years in terms of these overweightings or underweightings. And the most interesting thing on this page is still how overweight we are for telcos and how much of that will be distributed to the other 7 buckets further down the page. And many of you have seen us share this in the past, but what we're doing is simply following a pattern that China and others have proven out well, which starts with telcos, goes on to Web 1, goes on to e-commerce, and eventually goes on to business and consumer services that go online. Precisely what you see here, where we're still in that telco-heavy stage, but that'll mean revert to where China is over time and become very lucrative for the people that are in this room. Needless to say, you can paint by numbers over here and look for all the rows that haven't been fully fleshed out. Many of you have seen us share this before, and that's what we're trying to do. In a simplistic model, we're painting by numbers. We're looking for great entrepreneurs that you see over here that occupy rows that need to be filled in, if for no other reason than there are 25 or 30 long-only and long-short investors on Wall Street that already own those companies in China and would love to own the identical companies here in Southeast Asia. What does that mean for you? It means 2 simple things. Watch the first and the second rule of 25. The first rule of 25 is time immemorial. It's lasted for several years now. You've got to be of a certain scale to go public. It used to be you could be a $5 million gross profit company and go public, even in America. Times have changed. But you don't have to be a $500 million gross profit company. You basically have to be 25 and above. And that is a rigorous finding that applies to all non-Japan Asia public companies. It applies to all non-Japan Asia internet and software companies, and it applies to all non-Japan Asia internet and software companies that went public in America. Maybe it's 30 and above for America. The simple test on a GAAP financial basis Are you delivering $25 million of gross profits? That's the bogey. That's the goal. That's what you want to hit. Last but not least, there's a second rule of 25, which answers the question that many of you are starting to think about. When will you be able to take your company public? And that isn't important just if you want your business to go public. If you want your business to be funded, you've got to let the folks a few years ahead of you get public so that their VCs make money, so their LPs make money, and that money gets recycled back to you. We've already had a number of people tell us, we'd love to invest in Asia partners, we're not yet investors, we're waiting for the IPOs to happen for the other VCs and investors in South Asia we're already invested in so that we can give more money back to you. So there's a recycling of capital that has to happen for all of you to get funded in this room, and that leads to what we call the second rule of 25, which is a pretty simple rule. Some of you may have heard of a measure called the VIX, not the nasal rub if you have a cold. The VIX is the fear index. This is a measure of how volatile the markets are expected to be. This is what it's looked like for 30 years. It's sort of a left-leading distribution. If the VIX is greater than 25 on the day you want to go public, you ain't going to go public. It's as simple as that. It's a hard market. The water is too rough. And if you look at now what the VIX looked like in 2022, it was significantly elevated. But the good news is the VIX has come down in 2023. And if you think about when the markets will be ready for you or not, there's a really interesting finding. It turns out that when the VIX is elevated, it corresponds to missing teeth, missing IPOs. See all those gaps in 2009 or those gaps COVID happened at the beginning in 2020? We are now in a period where IPOs are coming back. Look at Birkenstock, look at Instacart, look at Arm, look at Oddity. It's happening again. It may not be at the valuations they hoped they'd get in 2021, but it's happening again because the VIX has calmed down. We're not in a blue spike right now. There is one final risk I want to talk about, and I'll leave you with a quick closing thought, which is as much as our region is ready to produce IPOs, because there are a lot of companies now in our region with 15 million or more of gross profit, 20 million or more of gross profit, 25 million or more of gross profit. Willis has been covering these day by day in Tech in Asia in row number 2 over here. The important thing is, will the markets be able to understand these companies? And here we have a real gap. We lack enough equity research analysts to cover the many companies that are going to be going public here. Now, what will likely happen is a lot of people will move from Hong Kong to Singapore to cover them, but we do need to produce our indigenous, locally aware equity research analysts, and all of us have to be part of that problem solution. I'll give you a final parting thought because we're running low on time. I have a view that the founders of 24 to 32 will change the world. This isn't just me being idealistic or, yip-yap kind of idealism at tech conference. There's data behind this. I want to show you something interesting. This blue undulating chart, it almost looks like a sine wave if you remember your high school trigonometry. This is one of the weirdest phenomenons I've ever seen in business. It struck us like a thunderclap. This is the percentage of American college students that graduate each year with a degree in computer or information sciences. It is bizarrely sinusoidal. You'd think it would just go up to the right. But no, it goes up, it goes down, it goes up, it goes down. And why does it go down and up? Because it mirrors the NASDAQ. When the markets are doing well and you enter freshman year, you decide to get a computer science degree. When the markets aren't doing well historically, you went and got a biology degree. True fact. It's a little different in recent years when both people wanted computer science and biology, but they've tended to cancel each other out to a certain extent. This is a hand-in-glove fit. And it turns out to be the case in Southeast Asia as well. Here's NUS in Singapore, computer science graduates, a very tight correlation to the markets. But here's the interesting thing. You can divide this curve over 50 years into periods when computer science, which is the lifeblood of our industry, was unpopular, periods when it was getting very popular, periods when it was decreasing in popularity, red, green, yellow. And you can divide up the last 50-odd years into the red period, the green period, and the yellow period, and you can ask, of the most successful technology companies, that 1% that Shailendra talked about 45 minutes ago, when were they founded? What was the zeitgeist? What was the atmospherics like at that moment of time? Well, I'm going to add up all these numbers real quick and you'll see it. 64% of the most successful tech companies, I left out telcos because many are state-driven, were founded when computer science was unpopular as a college major. Only 17% were founded when computer science was getting more popular, but most notably, computer science troughs produce 78% of the dollars of market cap. Why am I saying this? Because we see that the next 10 years will see a contraction in computer science graduate. That's our prediction. And the diehards, the really focused folks, the people that are going into the field not just to make money, but because they're good at it and they love it, those are going to be the founders of 2024 to 2032, and they're going to change the world because they're going to be part of the next cohort of 78%. With that, I'll pause. Thank you for the time, and we're always here to answer questions if you have any observations after this.